Uh, so in the last class, we slightly discussed that there are two types of costing systems, cost accumulation techniques we call them. One is process costing, other one is job order costing. When do we use process costing? When we have a standard product repetitively produced. You have a standard design, same product you keep producing continuously, we apply process costing. When do we apply job order costing? Specific orders. Each order is different. Each unit you process is different from the other units. Then we use job order costing. With that background, let's go and see each of them. Process costing first. Product costing involves accumulating, classifying and assigning direct material, direct labor and factory overhead cost to products, jobs or services. In developing costing system, management accountant make choices in three categories of costing methods. Cost measurement method, that's what we studied in the last class. Standard costing, normal costing or actual costing we studied in the last class. Now we are coming to cost accumulation technique. Cost accumulation systems. Process costing is used when many identical or similar units, that's what I was explaining now, many identical units of a product are being manufactured. Job order costing is used when units of a product or service are distinct. That's what I meant by unique orders or specific orders. Process costing is used to allocate cost to individual products when the products are all relatively similar and mass produced. Same stuff continues. Just let me show you the calculation part, how it comes. Process costing, earlier they had lot of calculations in it. Now in the new syllabus they have removed. So very basic only we have. We will have a T account for a process. All the inputs will be debited here, all the outputs will be credited here, output to the process. So what could be the inputs? Raw material. We'll have two columns, quantity and value. Again I am repeating, the calculation is not tested now, just for you to understand I'm just showing this. Raw material, let's say 1000 units raw material you have given, value $10,000. Then the cost also input like direct labor, overheads, you will have those inputs. They will not have anything as quantity, because quantity means number of units. Number of units depends only on raw material, labor and overhead, that will increase the value only. Then what could be the output? Output will be what you are transferring to the next process or finished good. If it is the last process, if it is the only process you have, this can be finished good. But if you have another process next, then this can be the transfer to the next process. So you can say finished good or transfer to the next process. Whatever the number of units, say 800 units. Value, there are some methods of finding the value, we are not going to study that. Then there can be losses in the process, you may have losses. These losses we have two categories, normal loss, abnormal loss. Normal loss means expected, anticipated loss. Based on past experience you might know 10% is going to be a loss, 15% is going to be a loss. So that is already anticipated normal loss. If the loss is more than what you expected, that is abnormal loss. So you will have normal loss, let's say 15% normal loss, that will have some value. Abnormal loss, balance 50. Then you balance the quantity is 1000. Value also you will balance. So this is process costing. Now let's say what they are showing in their slides. In reality, categories of cost that exist within single process can be numerous. They may include more than one type of material, more than one class of labor, etc. However, in CMA exam, only two classifications of cost are accumulated in the process: direct material and conversion cost. What is conversion cost? Labor and overhead together, you call it conversion cost. Labor and overhead together, you call it conversion. So they say direct material and conversion cost are the only two we will be having in our questions. Conversion cost include everything other than direct material, specifically direct labor and overhead. The costs that are accumulated in the process come from one of three places. Costs were incurred by the department, costs were transferred in from the previous department, costs were in the department on the first day of the period. See, these are difficult to explain without having numbers, because we don't study the calculations now, but still a couple of theory points are there. Read it. Let's see if it is tested in the questions. Okay, so equivalent units is there. What is this equivalent units? There can be sometimes in the output side you may have work in progress. Work in progress. What is the meaning of work in progress? Part completed units. At the end of the month, part completed units. Suppose you have 500 part completed units. Each of them you have done 60% of work. Balance 40% of work is remaining. What is the meaning of that thing? It's a furniture manufacturer. So maybe he has cut the wood for 500 tables and he has fixed them, but the remaining work of polishing, painting is not yet done. How many units like that? 500 units like that. So for calculation purposes, 500 units, each 60% completed, can be assumed as 300 full units, 300 fully completed units. How did I get 300? 500 times 60%. 500. There are 500 physical units. None of them is complete actually. Each of them only 60% of work is completed. As I said, you have done cutting, you have done fixing, but all 500 painting, polishing, it is still remaining. But for calculation purposes, what I will assume, this is equal to 300 full units. So I will find the cost of one full unit and allocate 300 full units cost for this 500 units. So this 300 full units is what you call equivalent units. Equivalent units. So what is the concept of equivalent units? Part completed items are going to be expressed in terms of full completed units. Part completed items are going to be expressed in terms of full completed units. This is called equivalent units. See, a manufacturing department has 100 physical units in ending work in progress that are each 40% complete for conversion cost. Then there is 40 equivalent units. 100 units, 40% completed is equal to 40 complete units. That's what they say, 40 equivalent units. So what is this allocating cost? Allocating cost means on this side you have all the costs like direct material, conversion cost, you have all that here. On the other side you are going to have finished goods, work in progress, losses. So this cost has to be allocated among these three. That only I said the calculation we may not study, right? This cost. So that is what they are talking about here. The company will calculate cost per equivalent units of direct materials and cost per equivalent units of conversion cost. The cost of the period are then allocated to the units that were worked on during the period on the basis of number of equivalent units. So this cost, total cost, will be charged to each of them, allocated to each of them based on equivalent units. But we don't study equivalent units calculations. Spoilage means losses. See if it is like, sometimes there can be breakages, sometimes the employees might make mistakes and you do reworking. That's what we call spoilage. Unavoidable spoilage is called as normal loss, but more than what you expected if you get a loss, that's called abnormal loss. Let's go and see the questions in it. Process costing and spoilage theory. Let's see, there are 16 questions. A manufacturing company has continuous flow cycle that employs simplified activities in short manufacturing cycle. The company produces a single product with minimal defect rate. Cost accumulation method that this company would most likely use, because they say continuous flow cycle, that means same product, standard product, continuously you are manufacturing. That's the process costing. Yes. Conversion costs are
C.
No.
cost incurred to convert raw material into finished goods, including labor and overhead. Yes, that's right.
Yes.
I'll explain this. Listen. Say raw material 2000 units, $5,000. Conversion cost $10,000. This is what you have incurred. Transferred to process to, let's say, 1700 units. Normal loss 200. That means you expected 200 units loss, but actual loss is 300, isn't it? You gave input of 2000, 1700 has come out, so 300 loss, 200 is normal loss, so abnormal loss 100. Now what we do, this normal loss, we will not allocate any cost to it, because we expected that loss. So we expect the good units to bear the cost of normal loss also. But this is already expected as loss, no point of allocating a cost to that. So that will not have a cost figure. But this one will have a cost, because this is an unexpected cost. This might be because of management inefficiency, abnormal loss. So that we don't want to leave it alone. What we will do now, take the total cost of 15,000, divide by these two, 1700 and 100, 1800. Wait, I'll change this to 8000, then we'll get some whole numbers. So you get $10. Then $10 into 1700, 17,000 cost will be allocated to this figure. 100 into 10, 1000 will be allocated to this figure. So do you understand? Normal loss, no cost is allocated. Abnormal loss, same cost as good units is allocated. Then what will happen? We will have a separate account known as abnormal loss account. These 100 units, $1,000, you complete the double entry here. 1,000 units, here you say process account, process 1. Sometimes these 100 units you may have a scrap value. That means if it is a defective unit, you can sell it in a secondary market for a small value. You may be able to sell it. If you are selling it, let's say you are selling each of them for $1. So 100 units, $100 you sold. Debit cash and credit here. So it's not balancing. 1,100. So where is the 900? That is the loss. Loss we will take to P&L. If we are not able to sell this unit, if it is scrapped, say breakages, then you can't sell it. Then the entire $1,000 will be taken to the P&L as a loss. So with respect to abnormal loss, we do this. We show a separate expense account. From there, we transfer the loss to the P&L. But for normal loss, we don't do that. So this question is about that only. You can see normal spoilage cost should be charged to the good units produced, because we don't charge a separate cost for normal spoilage. And abnormal spoilage cost should be charged to a separate expense account. That expense account is what is abnormal loss account. Clear? A manufacturing firm may experience both normal and abnormal spoilage in its operations. The cost of both normal and abnormal spoilage are accounted for in the accounting records. Costs associated with abnormal spoilage are
Charged to spoilage.
yes.
A.
Because normal loss is unavoidable. But abnormal means we expected that to be controlled, but management failed to control. So it's generally thought to be more controllable by production management than normal spoilage. So you can see we get theory questions like this.
Special loss account.
That better explains to allocate the cost to finished goods, work in progress and all. Cool. So that's it, what you call process costing in your syllabus right now. Very small topic. There are no calculations. It's all theory. That's it. Now let's go to job order and life cycle costing. Let me explain before we go into the slides how this works. Easy example for you to understand job order costing. Think about a car mechanic, right? Car workshop. So what happens when a customer brings his car with certain complaints? First, one officer will receive the car. Immediately after receiving, he opens up a job card. Usually it's a printed sheet where he will fill the customer details first. Customer name, number, contact details, he will write that. Then the complaints, what complaints customer is telling about the car, he will write down all that. Then he keeps this job card on the car dashboard. and he will inform whoever the mechanic suitable to do this job. He will inform the mechanic. So that mechanic will take the car. Let's say he does the work for 4 hours. So he will record in this job sheet, he will start at what time he started the work, at what time he finished his work. If he has used any materials, he will include what materials have been taken from the stores. If he has taken the help of other people, he will record here what other work has been done. Everything they record, they finish the work and they inform the accountant or the manager the work is finished. So manager will take this job card and he will do the costing. How much of material has been done? Where does he see material? He can see here all the material taken has been recorded. So he will find the material cost. Labor hours and which laborers have worked on it have been recorded. So labor cost he will calculate. And they may have a overhead absorption basis. Remember last class we studied overhead application rate, overhead divided by budgeted overhead divided by budgeted hours or budgeted basis. So they may have a rate, for example, $2 per labor hour. So yes, they may have a predetermined overhead absorption rate. Using that, they will find the overhead also for this. And they calculate the total cost of it. This process is what you call job order costing. Each job individually we do this costing. So usually we go for this material and labor will be actual figures we can take. Overhead we would take the absorbed rate multiplied by the actual hours. Now let's go and see what the slides say. Job order costing is used when each item the company produces is unique and identifiable from all others. Businesses commonly using job order costing. Audit firms, law firms, because each client's work is different, right? So audit firms, law firms, consultancy firms, shipbuilding companies, companies that produce something that is large or handmade, such as custom furniture, etc. Job order costing question is not different from standard overhead allocation question. Oh, that's all they have regarding job costing. Anyway, let's finish these slides and then we'll go to the questions. Life cycle costing means, what is life cycle costing? Each product has a life cycle. Don't confuse life cycle with useful lifetime. Useful lifetime means how long you can use a product. Life cycle means how long the company is manufacturing and selling the product. For example, iPhone, each model, the life cycle could be less than 2 years, 1.5, 2 years they manufacture and then they stop it. They don't keep manufacturing the same model again and again. So this life cycle we usually show by a diagram like this. Time and sale of a product. Usually we draw by a diagram like this. This initial phase is known as introduction phase, where there is a slow growth. Then this phase is known as growth phase, because there's a rapid growth of sales. Then this phase where the sales kind of stabilizes, the growth is no more, you call it maturity phase. Last phase is known as decline phase. Sales will start falling. Maybe a new product is being launched, new technologies are coming, competitors started reacting on your product, so you get sales falling, decline. So this whole period is what you call product life cycle. Before this period is known as R&D, research and development period. So including R&D, there are 5 phases. So what life cycle costing says, if you are going to manufacture this product for 2 years, then, okay, before I go to life cycle costing, assume if you are using traditional costing, let's say this is a 4-year life cycle, this is 1 year, 2024 you are launching this product, 25 is growth, 26 you will reach the maturity, 27 you are going to the product is going to have decline phase. If that is so, we will be doing costing on a yearly basis. 2024 we will do costing. Usually cost per unit will be high. Do you know why? Low volume. When the volume is low, cost will be high. Why is that? When you take the fixed cost and divide by number of units, you have less units in this year. So that will result in a high cost per unit. Second year, that will be lower because the volume increases. Third year, even lower. 27, it will start increasing again because volume is falling. So same product, year on year, the cost changes. Can you see, first year it looks like a loss-making product. And there will be a lot of marketing costs also. Marketing cost, here it will be very high. This year will be high. Still in the growth phase, you have to spend marketing. Here it can be low. Here it can be nil. So because of these variations, what happens? Same product, in the first year it might look loss-making. Second year it might look okay. Third year it might look profitable. So we want to avoid this. Why same product, time to time we have different cost, different profitability? To avoid this, what life cycle costing tells is, if your product is for 4 years, have one cost calculated for all 4 years. So what it says is, estimate the total life cycle cost. Total life cycle cost. What is the meaning of total life cycle cost? You have to estimate in all 4 years how many units we are going to manufacture. Estimate all the production cost, marketing cost, selling and distribution cost, everything for entire 4 years. Divide by 4 years number of units and find average cost per unit. That is what they call life cycle cost per unit. It's a bit difficult exercise, forecasting it for all 4 years. Imagine if the life cycle is 10 years, you're going to forecast this for 10 years. So that can be hard, but conceptually, this is what life cycle costing says. Don't have different cost figures for the same product in different years. Let's forecast the total cost for the entire life cycle at once. Then use the same cost every year. Same cost every year. If I simply put it, okay, 2024, 2025, 2026, 2027. Let's say total cost each year 100,000, 300,000, 400,000, 250,000. Number of units, say 1,000 units here, 4,000 units here, 6,000 units here, 3,000 units here. If this is the number of units, if you find cost per unit year on year, 100,000 divided by 1,000, in this year it will be 100. 300 divided by 4, this year it will be 75. 400 divided by 6, how much is that? 200 divided by 3, 66.67. This year it will be 83.33. Instead of doing this is traditional. What life cycle costing says, add up all the costs, 100, 300, 400, another 400, 800, plus 250, 1,050,000 life cycle cost. Life cycle volume, 1,000, 4,000, 5,000, plus 6,000, 11,000, plus 3,000, 14,000. Now, divide it. I think you get 78, is it? Yeah, 78. No, 75.
75.
75 average cost. So use 75 all the years. First year also assume it as 75, second year 75, third year 75, fourth year 75. So that this fluctuation can be avoided. Useful for internal decision making. Company does not determine the product cost in the short term sense of the production of one unit. company takes much longer view to the cost of production and attempts to allocate all of research and development, marketing, after sales services, and any other cost that is associated with this product its lifetime. So when you say life cycle cost here, this includes everything: production, marketing, research and development, selling and distribution, everything. Every accounting cost will be included. And they divide these costs into three. Can you see there are three headings: upstream cost, manufacturing cost, downstream cost. Upstream cost means before you start manufacturing: research and development, design cost, prototyping cost, getting the approvals, legal cost, all that is upstream cost. Manufacturing cost we know. Downstream cost is after manufacturing is over, like distribution, selling cost, commissions, marketing cost, all that. Marketing, distribution, after sale services, warranties, all that is downstream. Customer life cycle costing means each customer will also have a life cycle with the brand. A customer, say for example an insurance company, let's say, you have to get a customer. There is cost for that. You may have to, one of your marketing person may have to follow up with the customer again and again and get him involved in the insurance contract. So that's the introduction phase. Then this customer may stay with the insurance company for a period of 10 years or 20 years or whatever. That's what you call life cycle. Forget about insurance company. Think about a bank. Same, a customer joins a bank. He uses the bank facilities for a certain number of years. After a number of years, he might find another bank attractive. He might shift. So how long he is being with the bank is known as customer life cycle. And this customer life cycle, time to time different profitabilities will apply, because initially to bring him in, lot of resources will be used, lot of time will be spent. So initial phases this customer may not be that profitable, but after he becomes familiar with the bank, he might use most of the facilities of the bank, then he becomes more profitable. So any business can apply this for a customer also. If you take even Alnada, bringing a student joins, if it is CMA or ACCA, for one course or for one subject he joins, and slowly he will enroll for other subjects, and then he finishes the course. So this period is known as customer life cycle. Customer life cycle, that's what they are talking here. Short topics, you don't have calculations in it, short ones. Job order life cycle, there are 17 questions. Life cycle cost for the product is simple, add up everything. 5 million, 7 million, so that is 12, 3. Very simple, right? Life cycle cost also includes upstream production cost, research and development, initial setting up cost, everything has to be included. And what's the meaning of this part? Since those lock in most downstream cost. See, once a product is designed, then in the manufacturing phase, you can't reduce the cost much, because according to the design only you have to manufacture. So how much you are going to incur in the manufacturing phase is decided at the design phase. If you design a product more complicated, the cost is also going to be more. If you design a product which is less complicated, then in the manufacturing phase the cost is also going to be less. So your upstream activities lock in most of the downstream costs. And this, even without reading, I can say it's going to be job order costing, because in the same topic we are in. But read it. A new advertising agency serves a wide range of clients, including manufacturers, restaurants, service businesses, department stores, and other retail establishments. The accounting system the advertising agency has most likely adopted. Job order, because each order is going to be different. Specific project, yeah. The company uses life cycle costing to price its new product and desires a 10% markup over cost selling price.
Can you show the options?
Options.
So what we will do, we will add these costs, 260, and then these costs, 300, 100, 400, 460, 460, 260, 720. Then here you have another 180. So 900,000 cost is there altogether, isn't it? This is production cost. This is also cost, is it?
Yes. Production.
Yes. Wait. We'll add everything. Calculator. Let's add everything. 260 plus 900 plus 900 plus 900 plus 10 plus 300 plus 100 plus 50 plus 40 plus 60 plus 80. Total cost is this much. How many units you are going to sell? 300,000, because they say 100,000 each year. Year 1 only they are launching the product, divided by 300. $12 is going to be the life cycle cost per unit. Then they are going to add 10% margin to this. Margin, right? 10% markup. 10% markup. So on cost, you apply 10%. So the final price has to be this into 110%. 13.2 will be the answer.
So how you got 300?
Right.
Look at this one. Company expects to sell 100,000 units each year. When are they launching it? They will introduce new product in year 1. So year 1, year 2, year 3 only. Year 0 is only research and development happening. Can you see here? So year 0 you will not have sale. That also they said here. Year 1 only they are introducing the product. Am I clear? So 100 in this year, 100 in this year, 100 in the third year. 100, 100, 100, 300.
Okay.
So all these questions, the answer is going to be job order costing, right? So no point of reading it. Under life cycle costing, research and development costs are upstream costs.
Upstream cost.
A boutique garment company manufactures customized suits. The company number of customized suits produced by the company fluctuates widely from month to month. Which of the following costing system are most appropriate for the company? Definitely it is going to be job order costing, because specific orders. Question is, are you going to use actual costing system or normal costing system?
Normal cost.
Why normal costing system? You remember in normal costing system, what do we do? Material and labor will be actual, Overhead will be based on standard.
Standard
That's what I
predetermined.
explained today also. Remember, once you finish the car mechanic, the car repair work is done, material and labor, they will get the actual figures. But overhead based on the overhead application rate. Yeah, so that's the sort of questions you get. That finishes this one. Now let's go to overhead allocation. Chapter 9, 10, overhead allocation. Quite a big chapter it is. There are two broad classification of overheads: manufacturing overheads and non-manufacturing overheads. Manufacturing overheads, another name for that, factory overheads, production related overheads. Non-manufacturing can be administration, marketing, sales, distribution, all these are non-manufacturing overheads. Because there is no direct connection between the production of a unit and the incurrence of these overhead costs, manufacturing overhead costs of the company must be allocated to the units that are produced. That means, like when we say cost of a product, we say material. No, it doesn't write. Come on. We say material, labor and overhead, manufacturing overhead. This is what you call manufacturing cost. These two are directly identifiable with the product. You take a table, you know how much of wood you have used. You take a shirt, you know how much of fabric you have used. So easy to find it. Labor also you can measure how many hours you are spending for each product, you can measure. But overhead, how much of electricity bill for a table, how much of telephone bill of the factory for the table, it's not connected. So how we get this is on an applied basis or allocated basis. That's what they say here. Because there is no connection, we need some allocation basis. So what we usually do, the traditional allocation method, we take all the manufacturing overhead, we studied this earlier also, budgeted, manufacturing overhead, all of them, take it together, divide by a basis. Basis can be labor hours, machine hours, and you get a rate, overhead application rate. Use this rate, say if it is $5 per labor hour, then take the products and see how many labor hours spent for that product, multiply by 5, you get the manufacturing overhead. This is the traditional method, we say. So what allocation basis we are going to use, how do we decide that? The basis that company uses should be on that reflects production cost on the way overhead costs are actually incurred. Remember I said if another has to use this, we may take the lecture hours of each batch, because if we are taking more and more hours for a batch, means we are using more and more resources of the company, lecture hours. Manufacturing organization, manufacturer may use labor hours or machine hours, because if the company use more labor intensive processes, labor hours could be the basis. If the company uses more machinery, machine hours could be the basis. So this rate is they call predetermined rate, because we calculate this at the beginning of the month itself. You don't have to wait until the production happens. Once the budget is ready, you can calculate this, right? So you call it predetermined rates. Predetermined. Here budgeted amount of manufacturing overhead divided by budgeted activity levels of the allocation base. choices for level of activity. This denominator, what you are using here, budgeted basis, there are 4 different ways. First one says expected actual capacity or master budget capacity. You can include the number of hours based on your budget. Check your budget, how many units you are going to manufacture, how many hours you are going to use, multiply, you will get the expected hours. Or second one, practical or current attainable capacity. So it's kind of a theoretical. Let's go here and do an example. Okay. Let's say you are going to use machine hours. Let's say you have 10 machines. Every day you are working 2 shifts, so 16 hours a day. So if you are preparing it for a year, I'll do calculation like this: 52 weeks, 5 days a week, 16 hours, such 10 machines. 52 weeks, 5 days, so this gives you the number of days, 16 hours per day by 1 machine, 10 machines. We will multiply and get the hours. This is called theoretical capacity. That is his last point, theoretical or ideal capacity. How much do we get for that? 52, 5, 16, 10, 41,600 hours. Then we will come to practical capacity. That is also connected to the theoretical capacity only. See this. Practical capacity means we might say out of this 41,600 hours, there might be some wastages and losses. Some machines might break down. There might be a couple of holidays announced by the government for various reasons. So 10% of this time we will keep it as a spoilage. I mean wastage of time. 10%, 4,160 hours I am keeping as wastage. So actual hours that is possible to be used, 41,600 minus 4,160, 37,440 hours I will take it as the capacity. This is called practical capacity. That is the second point. First I explained fourth one, now I explain second one. Expected annual capacity means, look at the budget. Your budget says they are going to make 10,000 units. Let's say each of it takes 3.8 hours. So multiply, it's 38,000 hours. So that is budget capacity, based on budget. Normal capacity means normalized capacity. Normal or normalized, they say. Normal capacity. Normal capacity means you take this budget for many years, say 1, 2, 3 years. First year you are going to use 38,000 hours. Second year you are going to use 40,000 hours. Third year you are going to use 35,000 hours. Get an average of all this. What is the average number of hours? 38 plus 40 plus 35 divided by 3. This process is known as normal capacity, because there can be fluctuations, seasonality. Some years you may have more capacity, some years you may have less capacity. We want to average it out so that in the long term, in 2-3 years, every year you will have same cost per unit, not high and low based on number of hours. So that is normal capacity. See the average level that will be achieved over 2-3 years, including seasonal and cyclical changes. Wait, what are we discussing? When you are finding overhead application rate, you take the budgeted overhead and divide by the basis. So basis, how are we going to measure? There are 4 different methods. One is, I start from here, theoretical approach. Just multiply the number of days, number of hours and get it. Second, practical approach. Theoretical level reduced for idle time and downtime. Then first one, budget, that year's budget you are going to see. Then normal capacity. You take 2-3 years together and find the average number of hours. That is normal capacity. Let's go and start with the questions. I will explain more when we are doing questions. "55 questions are there. What a big topic that is. What's the requirement? The budgeted overhead cost for 1 unit of product A. Okay. Warren Company uses departmental rates to assign overheads to its 2 products. Budgeted data for the next year are shown below. Overhead cost in Department 1, Department 2. Cost driver 5 machine hours, labor hours. Machine hours given, labor hours given. Warren expects to manufacture 400,000 units of product A during the year. Each unit of A requires 0.5 machine hours in Department 1 and 1.5 labor hours in Department. Budgeted cost of this. Okay. So they say they use departmental rates, whereas that company uses departmental rates. Departmental rates means you deal with each department separately. You don't combine them. You will have a separate rate for Department 1, separate rate for Department 2. Department 1, overhead application rate is going to be overhead $5 million divided by what base is machine hours? 500,000 machine hours. You get $10 per hour. Department 2 overhead application rate is going to be 7 million overhead. What's the basis? Labor hours. Labor hours 1.4 million. So you get 5 per labor. This is per machine hour. This is per labor hour. Now look at this product. Product A requires 0.5 machine hours in Department 1. So when you look at product 1, Department 1 10 is the hourly rate, 0.5 machine hours. Department 2 5 is the hourly rate, 1.5 labor hours. So this is going to be the overhead charge to the product. This is from Department 1, this is from Department 2, add them together. So individually you find overhead application rates for each department, apply and get it. So this is 5, this is 7.5, $12.5 should be the answer. Is that clear? If they said plant-wide application rate, then we have to combine everything and get one application rate. But departmental rate means for each department you have to do it separately. Try this one. How much?
48.
A. Because budgeted overhead divided by budgeted machine hours, 1.2 million divided by 25. Don't take actual. Application rate is based on budget. Answer. How? They say corporate wide overhead rate. Corporate wide means you have to combine all of them. So if you combine, total overhead is $6 million. $6 million. And the basis is labor hours, right? How many labor hours? 100, 200, 300 labor hours. 6 million divided by 320. Why? They said corporate wide. Earlier they said department wide. Now corporate wide. Am I clear? What is this? Company's total manufacturing cost for November. Okay, let me start. But material purchase is going to be 163,000 plus transportation in 4,000 minus return outwards. So 165 is the purchase. Then usage will be opening stock 67 plus purchase 165 minus closing stock 62. So purchase is 170,000. Right. Sorry, usage is 170,000. So when they say find the total cost, material 170,000, labor 200,000. Question says company charges factory overhead to production at 70% of labor cost. 70% of labor. So the overhead that they are going to charge for this month is 70% of this, 140,000. That's all. Total manufacturing cost
100%.
510. You don't have to worry about actual overhead being different. Actually, in this case, look at this, there is something more. Absorbed overhead or applied overhead 140,000. But actual overhead for the month is 132,000. So this 8,000 difference, you call it over applied overhead. Over applied overhead. You have overcharged, right? So this 8,000 will be treated as an income because you have overcharged your products. You have put too much of cost, reversal of cost. So 8,000 will be treated as an income. I can subtract this 8,000. But what they say here, company does not formally recognize under applied overhead until year end. So this month they wouldn't have calculated this, they wouldn't have adjusted this, so I don't have to do this because until year end they are not doing it, which means only 510,000.
10%.
Let's check the answer. Correct. 502,000 would have been correct if they did this process in this month itself. Total amount of overhead applied to production for November. Read the paragraph. Nanjon's company manufactured a line of products distributed nationally through wholesalers. Presented below are planned manufacturing data for the year and actual data for November of the current year. Company applies overhead based on planned machine hours. Machine hours is the application basis using a predetermined annual rate. Okay, now start. Amount of overhead applied to production.
$320.
320.
No, let's see why. How did you do it?
Budget.
Budgeted.
Okay, so you took the budgeted overheads and divided by budgeted machine hours, you got a rate, is it? How much is the rate you got?
320.
No, the rate, overhead application rate.
14.55.
14.55 is the rate you got? Okay, just a minute, let me check. Why? Let me see. How did you get 14.55?
Based on machine hours.
Okay. Annual rate, right? Did you do it only for November or for the year?
Only for number.
Only for number.
No. Question says annual rate here. Predetermined annual rate. So you must do it for the year. That's why. Right, look here. So look at the annual data. This plus this 3.6 million divided by machine hours 240. You get 15. Then when you are applying overhead, how are you going to apply overheads? This is what we do. 15 per hour. You take the actual production multiplied by standard hours per unit. That means each unit, how many hours it must take. Each unit you produce, how many hours it must take. Not the actual hours. We will not use this one. We will not use that one. Not the actual hours. What we will use is plan based on output. Let me explain this on a different example. Just see here. If budget says machine hours 5 hours per unit, this is budget. Actual, say production 8,000 units. If actual production is 8,000 units, how we find applied overhead will be, you find the overhead application rate multiplied by 5 into 8,000. Why it is so? If you look at overhead application rate into 5 is what? Budgeted machine hours per unit. So when you multiply these two, this tells you budgeted overhead per unit. And then you multiply by the actual number of units. The point I want to highlight here, we don't take actual hours. Suppose if actual hours was 4.8 hours per unit, we don't take that. We take budgeted hours only. Budgeted hours for actual production. So take OAR. 5 is the standard hours of 1 unit. So multiply them. Then you multiply by actual production. So how do you call this 5 into 8,000? That is known as plan based on output, or let me say this way, standard hours or planned hours for actual output. Standard hours for actual output. That's how you call it. Not just actual hours. We'll do more questions, you will understand this. So here 15 has to be multiplied by 21,000 machine hours. That will give you $315,000 as the applied overhead for the month. Once again, you see, I divided the budgeted overhead by budgeted hours. I got the rate. Take the annual one because question says annual rate. Usually it's annual. Don't take the monthly rate. Annual rate. Multiply by the standard hours for actual production in that month. 350,000 is right. 50 into 21,000. Yes. Same question, they are asking predetermined overhead application rate for this company. 15 is what we got, yeah? Same question. Same question. Amount of over under applied variable manufacturing overhead. Look at this carefully. Amount of over or under applied variable manufacturing overhead. Let's go back there. If I do it only for variable overhead, can you see 2.4 million divided by 240? So variable overhead is going to be $10 per hour. Isn't it? 2,400,000, 240, the application rate will be 10. How many hours you are going to apply that for? For 21,000 hours you are going to apply. So 210,000 will be applied variable overhead. Applied variable overhead. But actual variable overhead is 214. 210 is what you applied. Actual is 14. There is an under application. You applied less. Under applied overhead. How much? 4,000. Applied is 210. Actual is 214. So applied is less. Applied is less means you call it underapplied. 4,000 underapplied. Correct? You can try this one. Right, so overhead application rate is going to be 250 divided by 100,000, 2.5. Also, let's find budgeted machine hours per unit. 100,000 machine hours. 100,000 machine hours for how many units? 50,000 units. So that's basically 2 hours per unit. Right. But during the year, the company produced 48,000 units. So now look at this. Applied overhead, how do I find? Remember the formula I said, OAR multiplied by standard hours for actual production. So OAR is 2.5. Standard hours for actual production. How many units they produced? 48,000. So 48,000 into 2. By 2 is the expected machine hours for 1 unit multiplied by 48,000. So this is the meaning of standard hours for actual production. So that's going to be 96 into 2.5, $240,000. Let's see the option and come back again. 240. Correct. See the working format. So this actual hours of 97,000 is just the distraction. Nothing else nothing to do with that. Don't take actual hours. And they have given actual overhead of 252,000. So in case if you want to find underapplied, overapplied overhead, what do you think in this case? Underapplied or overapplied? This is the actual overhead. 252 is actual. Yes, tell me.
Underapplied.
Underapplied. How much underapplied?
12,000.
12,000. They didn't ask that. Maybe in another question they will ask that. Underapplied 12,000. Underapplied has to be treated like an additional cost because you have applied 240 so far, but the actual is 252. Another 12,000 cost is there. So it's like a cost, additional cost. Like an additional cost. What is this? Using the following budgeted data for Valley Corporation, which produces only one product, calculates company's predetermined overhead application rate for variable overheads. They are asking only for variable overhead. On what basis do they say? They don't say that.
Is it D, sir?
Last one.
I'm getting that. I'm not sure.
Correct. See, what are going to be the variable overheads here? Indirect materials varying with production. So definitely that's a variable cost, $1,000. Indirect labor varying with production. So that is also variable manufacturing overhead. So 10 plus 1, 11,000. These two I have taken, 11,000. Factory supervisor's salary incurred regardless of production. That's fixed. Because they say regardless of production, don't take that. Depreciation of factory building and equipment, that's also fixed. That's fixed. Whatever the number of units you have, you are going to have depreciation. Utilities to operate factory machines, variable. Utility is to operate, for example, electricity cost for the machine running. If more units are manufactured, machine runs for more time and more cost. So that is variable. This 12,000 is variable. Security lighting for factory, fixed. Selling general administrative overheads, that is not even factory overhead. That is non-production overhead. Don't even consider that. So this 1,000, 10,000, this 12,000. 1 plus 10, 11 plus 12, 23,000 is the variable overhead. Divide that by units produced. Units produced, not units sold. Production cost must be matched with the production units. So 23,000 divided by 11,000. 2.09. Okay.
Units to be sold.
Careful, na? Units produced, not units sold.
Okay.
Units sold will matter when you are preparing the income statement. How much of cost must be taken into the income statement? 10,000, because sold 10,000. But when you are applying cost, it's production.
Okay.
I have seen the answer. Okay. Let's try this one. What is the cost would be charged to the production run? A company allocates overheads to jobs in process using direct labor cost, raw material cost, machine hours. It uses all three. 100% of direct labor cost, 20% of raw material cost, 117 per machine hour. A particular production run incurred the following costs. What is the total cost that would be charged to the production run? Where is my calculator? Right. Raw material 2,000. Labor 8,000. Right. These two are the direct costs. Now indirect costs, I have to do three calculations. 100% of labor cost. So another 8,000 I will apply for overhead. 100% of direct labor. Then 20% of raw material. 2,000 into 20%. 2,000 into 20% means 0.2. Then 117 per machine hour. 140 machine hours plus 140 machine hours. 117. 34,780. Look at the working here. 2,000 direct material, 8,000 labor. So those two tell us the direct cost. Then overhead I have to do it in three steps. 100% of labor. That's why I added another 8,000. 20% of raw material. So raw material 2,000 into 0.2 plus 117 per machine hour. This is the number of machine hours. Multiply 140 into 170. Let's check the answer. Yes. We'll do one more and finish it. Right. So material purchased, you have here purchase 189,000, purchase returns and allowances 1,000, transportation in 3, that means 191. Direct material used 191 plus opening stock 134 minus closing stock 124, that's 201. Right, now let's find cost of manufacturing cost. Manufacturing cost, how do you find? Material used 201,000 plus labor 300,000. Factory overhead they apply at a rate of 60% of direct labor cost. So this is direct labor, direct material. Overhead is going to be 180,000. How? 60% of this. So that is 300, 500, 681,000. This is manufacturing cost. From this we have to find cost of goods manufactured. How do you find that? Adjust for work in progress. Opening work in progress minus closing work in progress. Opening work in progress 235. Closing work in progress 251. When you do this you get 665,000. What is this? Cost of goods manufactured. Remember I gave you these formats earlier.
Yes.
Yes. Then you adjust for finished goods. Opening finished goods 125. Closing finished good 117. 173,000 is the cost of goods sold. Cost of goods sold. Don't worry about this actual overhead because they say until December 31st they don't do underapplied, overapplied calculation. So we don't have to worry about this figure. Actual overhead doesn't, it's not needed. 173, sorry, how much you got?
673.
673.
No.
Correct. Cool. So practice more questions on this. This can be a little tricky area, overhead analysis. Practice more on this. Next class, yeah, I've done 10 questions out of 55 questions. So there is another 45 questions you can try. Next class, tomorrow, we will see if you have any doubts on this. We will clear it. And then we will move on to others, activity-based costing, variable absorption costing and stuff.